What is your expectation from the Federal Reserve today?
Well, I think, as you pointed out, I think it should be a fairly quiet meeting. We're not expecting a lot from the Fed. There is a statement, of course, that comes with it, but there's no press conference. So we're not expecting any significant change. I think this is going to be one of the quietest Fed meetings. It's almost overshadowed a little bit by the Bank of Japan meeting that occurred yesterday and also the Bank of England meeting that's happening tomorrow.
Yeah, there's three big central bank meetings this week. I mean, you could really say three of the big four, taking out the ECB. How about this, Paul? What do you want to hear from the U.S. Federal Reserve? What would sort of be the Goldilocks scenario from our Fed?
I guess no real changes, and they've been very good at just walking us through a gradually rising interest rate path, which I think they are justified in doing. The economy's good, the employment's strong. There's no reason, there's inflation's picking up, there's no reason why they should change course. So I think just more of the same. I think if they change the wording too much, I think the market might get a little bit too excited for a few days. But essentially, I don't think we're going to get much. I don't think actually they should do very much to upset the market at the moment.
Yeah, you know, and it's funny because I think a lot of people in the U.S. market would have expected our 10-year bond to be at, 3.25, maybe 3.5%. Seems like we just can't get to that 3% mark, where we're 2 basis points away right now. It's 2 bips. What are you expecting from the U.S. Treasury market this year? Are we going to end the year higher than 3%?
Yeah, I still think the underlying trends of stronger growth, the fiscal stimulus still working through, inflation picking up, and of course more supply. We're getting more Treasury supply that's been ramped up in the second half of the year. So those factors, with the Fed raising the base every 2 or 3 months, I think that'll lead to higher rates. I think we will see yields above 3, getting towards 3.25, probably even possibly 3.4 by the end of the year. But at some point, that monetary tightening, that Fed tightening, the reduction in the balance sheet is going to have an effect, and it will have an effect on the economy, and that's what I think will flatten the curve off even more, and maybe even push it into an inverse curve by the time we get to the end of the year.